Welcome to the Deep Dive. We're the show where we really get into the sources, cut through the noise, and pull out the insights you need. Today, we're looking at Illinois Toolworks, or ITW. Maybe not a name you hear every day, but honestly, a fantastic example of what makes a business truly last. Our mission here is simple. We want to unpack ITW's operations, figure out what makes them genuinely different, their competitive edge, and understand how they stay so financially strong. Using the sources you provided, we'll dig up those surprising details, those key facts that help you become really well informed about a company that, well, quietly influences a lot of the industrial world.
That's absolutely right. ITW is this global diversified industrial manufacturer founded way back in 1912. An incredible history. It's one of those companies that sort of flies under the radar, but they've methodically built what you can only really call a business fortress. So our focus today is understanding how they do it. How do they sustain such exceptional profits and stay so competitive, not just for a few years, but, well, for over a century?
Okay, let's dive in then. How does this century-old company, ITW, actually make money? What's the core business?
Well, at its heart, ITW designs, makes, and sells a huge range of specialized, highly engineered products. Think critical bits and pieces for cars, construction, food packaging, general manufacturing, not consumer gadgets. They're structured into 7 distinct segments, and this is key. No single segment makes up more than about 20% of total revenue.
Diversification built right in.
Exactly. It gives them massive resilience. And just for scale, in their last full fiscal year, 2024, ITW pulled in about $15.9 billion in total revenues.
$15.9 billion, that's substantial. But what really jumps out from the sources is how profitable they are, especially for an industrial firm. They keep mentioning the ITW business model. What is that secret sauce?
Right. The ITW business model, it's really defined by this intense, almost obsessive focus on efficiency and creating unique value for customers. This allows them to charge premium prices. They're not playing the commodity game. And that leads to exceptional profitability.
How exceptional?
Well, in 2024, they hit a record operating margin of 26.8%.
26.8. For an industrial.
Exactly. In a sector where margins are often, pretty thin, ITW is consistently pulling in numbers like that. The sources call it best in class within the industrial sector. That's saying something.
That is definitely saying something. Okay, so where are they doing all this? Geographically, how are they spread out?
They're pretty well diversified globally, too, which helps. In 2024, about 54% of revenue came from North America, 26% from Europe, the Middle East, and Africa EMEA, and 20% from the Asia-Pacific region. And this isn't just about spreading risk. Being global lets them stay physically close to their customers. That's actually a core part of their philosophy, solving problems locally.
The sources had a table, key table 1, I think, showing segment performance. Can you walk us through some highlights? Show us how this model works across different areas.
Absolutely. That table really tells the story. Look at their welding segment, for instance. FY 2024 operating margin, 32.3%?
That's 32%.
Right. Or specialty products, 30.3%. Construction products hit 29.3%, being able to consistently generate margins near or even above 30% in such different industrial markets. It's just powerful proof of the model. It shows they're creating real defensible value.
So it's a complex global company, but the model itself sounds, well, surprisingly straightforward. How does that simplicity help it last for so long?
It lasts because ITW isn't chasing trends. They find specific, niche industrial markets where customers need innovative, critical solutions and, importantly, are willing to pay for that innovation. Their products are fundamental. Think transportation, construction, food production, manufacturing. These are bedrock industries.
Yeah.
And they have these 2 deeply embedded processes keeping them relevant. First is customer-backed innovation. They literally work with customers to solve tough technical challenges.
Okay. And the second?
The second is that 80-20 front-to-back process.
Right, the 80-20 rule. How does ITW apply that specifically? Because it sounds crucial.
It's absolutely crucial. It's based on the Pareto principle, 80% of results from 20% of effort. ITW applies this rigorously. They focus their resources, R&D, sales, operations, everything, on the 20% of customers and products that generate 80% of their revenue. And just as importantly, they actively work to eliminate the costs and complexity tied to the less profitable 80%, or the 20, as they sometimes call the less profitable part.
So it's about focus and simplification.
Intense focus. It leads to superior efficiency, higher margins, better capital use. It's a core advantage.
Okay, this brings us to the economic moat. The sources call it wide and formidable. Built on two main things, right? Intangible assets and cost advantage. Let's really dig into this fortress.
Right. This is where their enduring strength comes from. First, intangible assets. You see this clearly in their massive IP portfolio. As of late 2024, around 21,000 granted and pending patents.
21,000, wow.
Yeah. And it's not accidental. It comes directly from that customer-backed innovation process. They solve unique customer problems, develop proprietary solutions, and then patent them. It creates a real barrier. Competitors can't just copy them easily. And it lets ITW charge those premium prices. The sources mention over half their 2024 revenue was protected by patents or trade secrets.
That's significant. And the second pillar, the cost advantage.
That comes directly from the cost advantage embedded in the ITW 80/20 front-to-back process we just talked about. It's proprietary, trade secret methods honed over like 3 decades. It dictates how every single ITW division operates. Always focusing on that vital 20%, constantly stripping out waste and inefficiency from the rest. This discipline results in much better operational execution and structurally higher margins than peers. It's a system that constantly refines itself.
How do we actually see this moat defending the business? The sources mentioned product line simplification actually reduced revenue in 1 quarter, which sounds odd initially.
That's a perfect example, actually. The PLS initiative, product line simplification, did cause a small revenue dip, 0.9% in Q4 2024. But that's not meekness. That's the moat in action. Management is deliberately getting rid of low-margin, more commodity-like product lines.
Rooting the tree, essentially.
Exactly. They're protecting the core business's profitability and focus. The sources say this discipline is precisely why their segment operating margins are often double their peers. It takes guts, strategically.
And this moat isn't just sitting there. The sources argue it's actually getting wider. What's the evidence for that?
Yeah, there are 3 really strong indicators. First, look at the sustained expansion of operating margins. Since they fully implemented their big enterprise strategy back in 2012, the company-wide operating margin went from 15.9% to that record 26.8% in 2024.
That's almost an 11 percentage point jump.
Huge improvement. Almost doubled their operating efficiency in about a decade. Second, their return on invested capital, or ROIC. This tells you how much profit they make for every dollar invested in the business. ITW's after-tax ROIC more than doubled from 14.5% in 2012 to an elite 31.2% in 2024. That's just generating massive economic value.
31% ROIC is a top tier.
Absolutely. And third, their strategic goal is to boost the yield from customer-backed innovation, CBI. They want CBI to add over 3% to annual revenue growth by 2030. That's up from 2% in 2024, which itself was already double what it used to be. You see this virtuous cycle. Decentralized culture enables innovation, 80/20 focuses it, leading to high margins, strong cash flow, which they reinvest. It feeds itself.
Okay, this paints a very strong picture financially and strategically. But what about the people? What do customers and employees actually say? The sources mentioned a Scuttlebutt investigation, basically getting the word on the street. What did that uncover?
Well, it largely backs up the story. Customers generally seem to hold ITW products in high regard for quality and effectiveness, especially the brands you might see in stores, like their Easy Anchor Twist and Lock drywall anchor. You find it at Home Depot. Online, it has this impressive 4.6-star rating from over 2,400 reviews. 82% recommend it. People praise how easy it is, how well it holds. They call it a superior alternative.
And thereby to reviews.
Yeah, the sources noted an official ITW brands account often replies, even to negative ones, suggests they're paying attention. But maybe the most telling bit, though anecdotal, came from an employee review site. Comparably.
What did they say?
This employee, talking about a specific product, said, "We have a unique film that customers cannot source elsewhere. We charge an egregious price for it, and our service is average at best."
Egregious price and average service. That's blunt. What does that tell you?
It's incredibly revealing, right? Cannot source elsewhere. Points directly to a lack of substitutes, a key part of a moat. And egregious price confirms significant pricing power. It suggests that for certain critical things, ITW is the only real option, so customers pay up, even if the service isn't amazing. That's the moat providing cover. Plain and simple.
Fascinating. What about the broader employee view? What's the culture like inside ITW?
Overall, pretty positive based on those comparably reviews. About 70% positive out of nearly 250 reviews. A recurring theme is the unique culture. Driven by decentralization, employees say it gives a small company feel, lets them own our destiny, seems to foster real ownership. They also consistently praise the benefits 401k match. Health insurance are often kind of above average or very strong.
But it wasn't all perfect, right? Were there downsides mentioned?
Yeah, a few things came up. That same decentralization means employees feel they need to be better advocates for themselves. Some mentioned a potential divide between management and production floor folks, and maybe some concerns about complacency creeping into middle management. So, while the culture seems like a net positive, a real strength, these are kind of the soft factors you'd want to keep an eye on. Operational excellence relies on everyone being engaged.
Right, so operationally strong, culture, mostly positive. Let's shift to leadership. Who's running the show, and how are they managing all the cash this business generates? The sources highlighted a textbook CEO succession.
Yeah, that was handled very smoothly. Santi, the CEO from 2012, who really drove that big enterprise strategy transformation, retired at the end of 2023. His successor, Christopher O'Hurley, became CEO January 1st, 2024. Crucially, he wasn't an outsider. He was a long-tenured insider, promoted after what the sources called a rigorous multi-year succession planning process.
So continuity was the goal.
Exactly. It signals stability, sticking to the strategy. And O'Hurley's public comments echo this. He talks like a disciplined steward, focusing on leveraging the business model and driving above-market organic growth fueled by customer-backed innovation. It sounds like a direct continuation of Santi's owner-focused approach, prioritizing long-term value.
That makes sense. So how does this disciplined stewardship play out in their capital allocation? Where does the money go?
They have this very clear, disciplined, and frankly, very shareholder-friendly framework. 4 clear priorities. Priority 1, the highest, is reinvestment in the core business, funding organic growth, R&D, productivity. They put about $800 million into this in both 2023 and 2024, feeding that innovation engine.
Okay, number 1 is reinvestment. What's next?
Priority 2 is providing an attractive and growing dividend. ITW is a dividend king. They've increased their dividend for 61 straight years. 61.
An incredible track record.
It really is. They bumped it 7% in 2024, paid out about $1.7 billion total. Priority 3 is selective, high-quality acquisitions. This is a distant third. They're very disciplined here. Looking for smaller bolt-on deals that fit strategically and boost long-term organic growth. Definitely avoiding empire building.
And the last priority.
Share repurchases. Any surplus cash left after those first 3 priorities gets returned via buybacks. They repurchased $1.5 billion in stock in 2024, planning another $1.5 billion in 2025. It meaningfully shrinks the share count over time.
That really does sound like a gold standard approach.
Yeah.
How do the actual financials confirm this picture of a financial fortress?
Oh, the numbers absolutely back it up. ITW is described as a remarkably reliable earnings machine. They consistently generate strong profits, grow EPS through different cycles. EPS has more than tripled since 2012. And look at 2024. Revenue dipped slightly, 1.3%, because some end markets were soft. But ITW still delivered record operating income, $4.3 billion, and those record operating margins of 26.8%.
Expanding margins when revenue's down. That's impressive.
It shows real pricing power and cost control. High-quality earnings.
And what about those key quality ratios, the ones that show the underlying health?
Right, let's hit those. First, return on invested capital, ROIC. For 2024, a record 31.2% after tax. Just an elite number, putting them top tier among industrials. And remember, that's more than double where it was in 2012. Shows massive value creation. Second, free cash flow, FCF conversion, how much profit turns into actual cash. ITW aims for over 100% conversion long term. They hit 104% in 2023, 94% adjusted in 2024. Generated a record $2.8 billion in free cash flow last year.
So the earnings aren't just on paper.
Exactly. It's real spendable cash. That's what fuels the dividends, the buybacks, the reinvestment. It proves the quality of the earnings. And lastly, balance sheet strength. It's a fortress. Net debt around $7.4 billion against EBITDA of about $4.7 billion in 2024. That gives a net debt to EBITDA ratio of roughly 1.6x.
Very conservative leverage.
Very. Means they could pay off their net debt in well under 2 years of earnings. Provides huge financial flexibility and safety.
And Key Table 2 in the sources track these over time.
Yep. That financial quality scorecard, 2018-2024, shows consistent strength across revenue, net income, operating margin, ROIC, FCF conversion. It paints a clear picture of sustained financial excellence.
Okay, so the deep dive confirms ITW is a truly high-quality business. Phenomenal operations, strong moat, great management, solid financials. But now the critical question for any learner. What about the price? Is the stock attractive value today?
All right, valuation. As of late June 2025, ITW is trading around 21.7 times its trailing 12-month earnings. That's the PE ratio, and about 25.8 times its price to free cash flow, or PFCF.
How does that stack up historically for ITW?
Well, that PE of about 21.7x is actually below its 5-year historical average, which was closer to 24.9x, and also below its 10-year average of 23.5x.
So a bit cheaper than usual.
Relatively speaking, yes. So, the overall judgment, based on everything we've discussed, the widening moat, elite profitability, top-notch management, is that the current stock price represents a fair entry point for a long-term, business-focused investor. Look, ITW is rarely going to look statistically cheap. The market knows it's high quality and usually gives it a premium valuation, and rightly so. But right now, it's trading at a modest discount to its own recent history. The sources suggest this is likely due to market focus on the near-term organic growth guidance, which is a bit subdued for 2025, 0% to 2%.
So the market's focused on the short term.
Seems like it.
Yeah.
For a long-term owner, this might create an opportunity to buy into this superior compounding machine at a reasonable price. You don't get a huge quantitative margin of safety, maybe, but the immense quality of the business itself provides a strong qualitative margin of safety.
That's a clear distinction. Looking ahead then, what's the main engine for ITW's future growth? Where's the focus?
The number one driver, the explicit strategy for 2024 to 2030, is achieving high-quality, above-market organic growth of 4% or more per year. And the fuel for that is customer-backed innovation. It's not about big M&A. It's about using their decentralized structure to get even closer to their core 80 customers, understanding their next challenges, and developing those proprietary, patentable solutions.
Any specific areas they're targeting?
One key area mentioned is the automotive OEM segment, specifically leveraging innovation to gain share in the booming electric vehicle EV market.
Makes sense. Now, even for a fortress like ITW, there must be risks. What are the big long-term threats that could genuinely permanently damage the business?
The sources identify three main ones. First, a prolonged global industrial depression. ITW is resilient in normal recessions, but a really deep, structural, long-lasting downturn across its key markets, auto, construction, general industrial, that could really hurt their long-term earning power beyond what diversification can handle. Second, and maybe the biggest internal risk, is an erosion of the 80-20 discipline. That 80-20 system is the absolute bedrock of their cost advantage and high margins. If some future management team abandons it, maybe chasing revenue growth at all costs,
It would undo everything.
it could reintroduce complexity, crush margins, basically destroy their core competitive advantage. It's a cultural risk, needing constant reinforcement. And third is technological obsolescence. While diversification helps, a truly radical tech shift could make products in a core segment, say welding or polymers and fluids, obsolete faster than their customer-backed innovation can adapt. That would be a major blow.
Okay, so we have our deep perspective. How does this compare to the general Wall Street view? What's the market consensus and where does our analysis differ? The second level thinking part.
Right. The prevailing Wall Street narrative is pretty consistently a hold. Most analysts seem to agree ITW is a fantastic, high-quality, well-run company. But they point to the current cyclical headwinds, the slowing near-term growth figures, that 0-2% guidance, and conclude the stock is fairly valued with limited short-term upside potential.
So good company, fair price, but wait and see.
Pretty much sums up the consensus. Our deep dive view differs not really on the quality assessment, but on the long-term interpretation of what's happening now and the valuation. The market seems overly focused on near-term cycles, and we think fundamentally underestimates the long-term compounding power of ITW's widening moat and their superior capital allocation skills.
Oh, so.
Well, take that product line simplification, PLS revenue drag. The market sees it as weakness. But looking deeper, you see incredible discipline, the moat in action, pruning to strengthen the core. It's a sign of strength, not weakness. The market sees a cyclical industrial at a fair PE. We see an elite compounding machine growing its intrinsic value at a high rate, that 30% plus ROIC, available at a reasonable multiple. So the market focuses on cyclicality. This analysis focuses on structural superiority and durability. That short-term market focus, the sources argue, creates the opportunity for the patient, long-term investor.
Let's try to boil this down. If you were putting together a one-pager investment memo, what's the core bull case for owning ITW?
Okay, the bull case. 4 key points. 1, durable, widening moat. That combination of the proprietary 80-20 operating system, cost advantage, and customer-backed innovation, intangible assets patents, creates a self-reinforcing fortress. 2, elite financial profile. It's a financial fortress. World-class ROIC over 30%, near 100% free cash flow conversion, conservative balance sheet, just rock solid. 3, exceptional management and capital stewardship. Proven, rational, owner-oriented leaders. That 61-year dividend growth streak and smart buybacks show they know how to allocate capital effectively for shareholders. And 4, fair price for quality. It's not dirt cheap, but the current valuation is reasonable relative to its history and immense quality. A sensible entry point to own a superior compounder without overpaying.
All right, crystal clear bull case. Now, flip side. To challenge ourselves, what's the bear case? Why might you hesitate or avoid ITW?
The bear case has points too. 1, cyclical headwinds persist. They are exposed to auto, construction. A severe global recession could hit earnings hard in the near to medium term, testing patience. 2, valuation offers no obvious bargain. It's fair, yes, but not an absolute steal. Priced for good execution, so there's less room for error or a worsening macro picture. 3, the law of large numbers. ITW is big now, over $70 billion market cap, $16 billion revenue. Achieving the really high growth rates of the past just gets mathematically harder. And 4, execution risk in the new strategy. Pivoting to focus on 4% plus organic growth is different, arguably harder, than the previous decade's margin focus. There's inherent risk in executing that shift successfully at scale.
Okay, that sets up our final challenge. If an investment in ITW today turns out to be a major long-term mistake, what's the most likely, most potent reason why? Our red team challenge.
The most potent counter thesis, the core reason it could be a mistake, is this. You're paying a premium quality multiple for a business whose best days of improvement are behind it.
Meaning the low-hanging fruit is gone.
Exactly. The sources argue that the incredible margin expansion, 16% up to nearly 27%, was brilliant, driven by that initial aggressive 80-20 implementation. But that phase is largely done. The next phase, the current strategy, is all about accelerating organic growth. And that is just fundamentally harder, more competitive, more uncertain than internal simplification and cost-cutting.
So the risk is the growth doesn't materialize.
Precisely. Ask yourself, what if that 4% plus organic growth target just proves too hard to hit consistently, maybe due to slower global growth or geopolitics? What if customer-backed innovation, while great, can't generate enough big new products to really move the needle for a $16 billion company year after year? Now, in that scenario, ITW wouldn't collapse. It would likely just mature into a very high-quality but ultimately low-growth industrial stalwart.
Which sounds okay, but...
But if you paid over 20 times earnings for a company that then only grows its earnings per share at, say, 3% a year, basically GDP-like growth, that's a classic quality trap.
Ah, the dreaded quality trap.
Right. You don't lose money permanently, maybe, but you face a decade of stagnant returns. Huge opportunity cost. The critical error would be mistaking the past decade's success formula, margin expansion, as a reliable guide for the next decade's strategic challenge, organic growth. The game has changed.
That's a really sharp articulation of the key risk. So bringing it all together, what's the core takeaway for you, the learner, from this deep dive into ITW?
I think the core insight is that ITW is just a fantastic case study in building durable competitive advantages and exercising disciplined capital stewardship. It shows the power of focus, of execution, but it also shows that even the absolute best businesses, like ITW, have to constantly evolve. They face new challenges as they grow and mature. No company can just rest on its laurels.
And a final thought to leave you with. Given ITW's amazing track record of boosting margins through discipline, and now their clear shift towards accelerating organic growth, think about how businesses evolve their strategies. Can a company that truly mastered efficiency in one era successfully pivot to master top-line growth in the next? Or does that very success, that scale, maybe even limit its potential in the new game? Something to consider whenever you analyze any business.